Welcome back to the QX Financial Podcast. I'm Charity Allred, and here we have Janko, our CEO. We're happy to come to you today and talk more about the Be Your Own Banker concept. Specifically, today we're going to be talking more about the actual real-life examples that we have prepared for you. And keep in mind, these can be very flexible, and they are something that can help you in just your everyday financing and your everyday budgeting. So go ahead and talk to us more about that, Janko.
Exactly right. So as Charlie saying, today we're going to keep it big picture. I'm going to show you one real life example, one real client that we have. But once again, this might be different to you, right? You may want to design your plan differently. You may have different goals, and that's okay. My goal today is just to get the concept across, get you understand how the concept works, and then we can work with you individually if you so choose to develop a plan that fits what your needs are, what you can afford, and what you want to do with it. So with that being said, let's get started. So before we dive into any numbers, I just want to remind us of three key concepts: opportunity cost, wealth transfers, and fractional banking. If you guys do not remember what those means, please go back to our QX Financial YouTube channel. We have a couple of videos explaining each of those concepts, but those are the key concepts that we use to understand the banking process and why it's meaningful, right? Opportunity cost, meaning that when you do one thing, you're not doing another, right? Money is only doing one thing at a time. What we want is we want to do multiple things at the same time, right? Even when you pay for things in cash, even when you have no debt, you're still paying an opportunity cost, which is the future growth of that money. So can we close that gap or potentially eliminate it? Wealth transfers, well, those liabilities that are in your budget, those car payments, those rental payments, that credit card payment, all those are wealth transfers. We want to avoid those as much as we can and put the money back to work for you. And lastly, fractional banking, which means to mimic what banks do to multiply money in a certain way. That's what we're trying to mimic as you become your own banker. So obviously, we're not going to open like an actual bank for you. You're not going to become a bank in the traditional sense of the word. The idea is to mimic the process so it's profitable for you as it is for financial institutions. Okay. So with that being said, again, if you have further questions about the concept, go back to the videos. They'll explain what those concepts are in detail. So now let's jump into our first client. So the first step in creating your own bank is what we call the capitalization phase, meaning we gotta put money in the bank. If we want to be able to use it, we gotta have money. So this particular client decided to save $1,000 a month, $12,000 a year over a 7-year period. And then she's gonna start using her account. Do you have to wait 7 years? No, of course not, right? You don't have to. It depends on how we design the account for you. So again, this is just this one client that decided to wait because she could afford to wait. She didn't have any major purchases coming down the pipeline. So she was able to extend her accumulation or capitalization phase. But we have clients that start doing this, in 20 days, in 30 days, right? All depends on how soon do you want to start doing it. So here you can see what I just explained. Doing for 7 years, the client is putting $1,000 a month, and that's what goes in the account. After that, she's not putting any more money. So her capitalization investment or deposit was 84,000. If you take 12,000 times 7, that's 84,000. That's the amount of money that she's putting from her savings out of pocket. After that, she's not going to be doing that anymore. She's done. So the volume of capital that she's putting in the account is 84,000. That's important. That's the number that I would like you to remember. So I would like now to draw your attention to these two columns, the gross cash value column and the net cash value column. And you'll see that in year 7, the last year of her capitalization phase, those two numbers match. They're equal, about 80,000, right? That's the amount of liquidity that exists in her account. Yes, she put in 84,000. She gets access to about 80. Why? I'm going to explain that in a little bit, but just remember that she almost has dollar for dollar access to her capital. And then what happens? Well, in year 8, she needs to buy a car. And that's what these $47,000 are for. So now she's taking $47,000 from her account. Now she goes out there and she's going to buy that car, right? Let's go back to the gross cash value, net cash value column. So what you see is that the net cash value column has gone down. Obviously, right? Because she took out $47,000 out. But do you notice that the gross cash value actually went up? This is the column we're going to pay her interest and dividends on. Not on the 43, but on the 92. That's kind of cool, right? Because then she had 80,000, she withdraws 47,000, yet she remained able to earn interest and dividends on 92. Pretty cool. So when we talk about opportunity cost, that's what we're talking about. She's not giving up the interest on the 47,000 because she needs the car. She's actually going to get the car and to continue to earn interest on that principal, even though her value, that what she has access to moving forward, is only 43. That's what we want, right? The logical question that you might be thinking right now is, well, this sounds great, but how is that possible? How can she spend $47,000 out and you still pay her interest on $92,000? Well, the reason for that is because this $47,000 is not her money. This is the insurance company's money. And this will be the first time that you hear the word insurance, specifically life insurance. And when I say the word life insurance, I know a lot of you are going to start rolling your eyes. Oh, here we go. I know what this is. It's a life insurance sale. No. What happens is most people don't understand what life insurance actually is. Most of us understand life insurance as, you know, I'm paying money to somebody so that when I die, my wife gets a bunch of money and somebody else enjoys it. Not really exciting proposition for your dollars. But that's not the way the government and the industry understand life insurance. Life insurance is about replacing your income potential, your economic potential. If you were to die too soon, we want to replace that economic potential. Take your income, multiply times how many years you're going to be active. Well, that could be $1 million, $2 million, $5 million. If you die too soon, that's your economic output that you will not be generating if you were to die too soon, right? Well, according to the IRS, that economic output is an asset, like a piece of property, right? It's a financial asset. So you'll see right here, I want to draw your attention to these two columns. You have $1.5 million of death benefit. That's whatever we decided we want to deposit to be at for all kinds of underwriting processes that are beyond the scope of this meeting. That's the number that we came down with, right? So that literally is a financial instrument. It's a financial asset that you can leverage, that you can borrow, that you can set up as collateral. You can do whatever you want. So the question then becomes, why will the insurance company lend this client $47,000? Very, very simply because the client is posting collateral. What collateral? Her death benefit. I want you to notice how here she has 1.562 million, but if she was to die that year, she doesn't get that. Her family only gets 1.513. Why? Because she owes the insurance company $47,000. In other words, what she's doing is she's taking her future economic potential or income potential and using it as collateral today so that her actual money continues to earn interest. Her money hasn't left the account. Her money is still there. We're using the insurance company's money. Think of it like a mortgage. If you buy a mortgage, what is the financial instrument you have? The house, right? The real estate. That's your financial instrument that you are posting as collateral so you can get the mortgage. The collateral is the house. That's the economic or financial asset that you're using as collateral. In this scenario, we're not using a house. We're using your economic output, your economic potential. That's what we're using as the financial asset. So that's kind of cool because now she's leveraging on money that she will never see because she will have to be dead to see it. Therefore, allowing her actual money to be here and continue to grow.